Welcome back. We're talking to Jack Lowenstein again from Morphic Global Asset Management. Welcome, Jack.
Thank you. Happy New Year.
Happy New Year to you. How did 2014 end up?
It ended up very well. We had a reasonably good year. It was a tough year to get a lot of our performance because most asset classes seem to move very closely together. But we managed to get to end up the year about 20 basis points ahead of the index after all fees, which we think is a pretty good outcome. And that was after a pretty lean start to the year because we had a very, very bad February, as you may recall. So we spent most of the year catching up and finally got ahead of ourselves. So we're pretty happy about that.
So in real terms, up 14%. That now gives you, I think, something like 27% annualised since inception in just about 2.5 years ago. Yeah. That's not a bad start.
I think what makes us most happy is that every single monthly cohort of people who have entered the fund have actually made quite substantial real gains. And all but 1 month has actually had outperformance of the index. So we've had very consistent performance over time. And while we haven't absolutely shot the lights out, we've delivered people what they wanted, which is an index-like return with a slight bonus.
And at the moment, the currency's helping you?
It's certainly been a very useful tailwind, although so far this month in January, it's actually really gone a little bit against us, which was a bit unexpected. But I think we do expect the Australian dollar to weaken quite a lot over the course of 2015, probably towards 75 cents US.
And looking forward in other areas, what are you expecting in global markets and maybe in commodities in particular, given the oil price?
The big shock has obviously been the oil price. We've been fortunate in that we've been underweight both the oil sector itself, and also we've been overweight parts of emerging markets that benefit from a lower oil price and lower commodities like India and China, and underweight the parts of the emerging market complex that enjoy a high commodity price, like Brazil and Russia, Indonesia, and so on.
And probably the other big question for 2015 is interest rates in the United States, where you have significant exposure. What are you expecting in that regard?
We have taken a lot of profits on that trade, but we're now rebuilding the position again because, in fact, we're very confident that interest rates will start to go up towards the middle of the year, probably in June.
To date, the market has taken the concept of higher interest rates in its stride pretty well. I mean, it certainly hasn't fallen out of bed. Do you expect there to be a change to that when the inevitable rise takes place?
I think there's so many people who will say it'll never happen, it'll never happen. The rates market itself is discounting what the Fed is saying very aggressively. So the real concern we have is that if the rates market has in fact mispriced that risk quite a lot, the equity market might itself get a surprise, more of a surprise, because the rates market spends all its time looking at the prospect for interest rate rises. The equity market does it as a sort of secondary activity. So if the rates market is taken by surprise, the equity market could really be a bit shocked. I don't know why they'd be shocked, because I think any responsible manager of equities, global equities, is looking at what happens in rates markets because it's such a big driver of performance, and therefore you say they shouldn't be surprised, but there's a real risk they will be surprised.
And presumably you'll have hedges in place that will hopefully either profit from that or hedge the downside?
Well, I think at the moment we're very confident we do have a hedge. Whether we've got sufficient quantity, I'm not quite so sure. But the very fact that we are short US Eurodollar futures, which means that if interest rates rise, we'll make money, means we have some protection if the equity market takes against that. And we don't think there's much downside. It's quite asymmetric. We don't think rates are going to fall. We think they might rise. If they do rise, it could be negative for the equity market, but it'll give us a very useful hedge.
Just turning to a couple of other areas, China in particular, where are you seeing China at the current time?
China's having a bull market. I haven't seen one for a long time. It's quite exciting. We are always a bit concerned about parts of China, and we're very concerned that the strongest rallying sector of the market has been the banking sector, which we're not involved in. We've got some concerns about the strength of the institutions and the quality of the reporting there. But we have found a few areas where we think there's quite a good proxy for higher consumer growth, higher consumption growth. So we're investing in the toll road sector, which we think is a good proxy for the rising number of cars and the fact that more and more Chinese people are obviously taking leisure time activities. And of course, if there is any kind of sustained industrial activity, which is obviously going on, the toll roads really benefit from that because they get a lot of their income from freight.
Two other areas that you're involved in, you've been very bullish on India in the past, and you've also got good exposure to Japan. What are you expecting there?
Very different stories. In Japan, we've really honed down our exposure a lot. Our major gains in Japan have come from the drugstore sector. Pretty well since we started, it's been the biggest win for us. And again in December, we had a very good run in that sector. This is a sector which has got demographic driver of an aging population who want both spend more money on medical-related items and also want to go shopping more regularly for smaller baskets. And the drugstores really fit into that. Our last stock in that sector is a very profitable business called Kusuri no Aoki, which is based in a remote part of Japan called Hokuriku. It's a very fast-growing drugstore chain, and we think it's quite reasonably priced for the growth and has done exceptionally well for us in the last 3 months or so. So that's Japan, if you like, so our major exposure there. And in India, we've really focused on the financials. We've been fortunate we've managed to pick both the best performing private bank, being Axis Bank, and one of the best performing public sector banks, government controlled banks called Canara Bank. And those are our largest two positions in India. And they've done quite well for us, and we feel they've got a lot of legs in them still for the year ahead. I'd say I would expect the private sector banks to slightly underperform the public sector banks next year because the public sector banks are still very cheap and there's a lot of structural reform going on. Plus they've got the cyclical benefit of falling interest rates because of inflation falling so rapidly in India. And India is a great beneficiary of a low oil price.
Finally, Jack, Europe, bit of a basket case at the best of times. What are you seeing for 2015? I'm pretty cautious about Europe, to be honest. I think that there's a lot of things that are problematic there. The biggest problem, I think, if you compare Europe, say, with Japan, Japan is a coherent country. Europe is still a work in progress. If it is going to be a single country, it's got a long way to go. But they're trying to create institutions that operate across borders, like the European Central Bank. The ECB is expected to try and introduce a form of quantitative easing, money printing, during this month of January. But I think if the past is any guide, they will do too little, too late. Okay, Jack, thank you very much indeed for your time. We'll look forward to talking to you again next month.
Thank you very much.
Thank you.